Now to kick-start this series, we'll start with 5 golden rules to follow before you invest. This will help you to approach investing with the right psychological mindset. Now first, have an emergency fund. Now for all individuals, it is very important to ensure that you have emergency fund set aside for any unforeseen circumstances, emergency or living expenses that occur. Now this typically, the emergency fund is about 6 months to 1 year of your living expenses. Now with this emergency fund, it will help you to avoid being forced to sell your holdings when there is a need to use cash. Second, never borrow to invest. Leverage, debt, loan, whatever you call it, borrowing to invest in the stock market is a definite no-no. Now, this should be quite obvious to us in normal circumstances. Now, but when the share prices are going up and the greed got the better of us, the FOMO in us will cause us to take excessive risk. Which is why when you invest, you need to know that taking on loan or leverage to invest will put your financial health at risk. Third, try to hold your stocks for a minimum of 5 years. Now if you put your money into the stock market, you must be willing to leave it for years, if not for decades. Now if you ask investing legend Warren Buffett himself, the ideal holding period of a time is actually forever. Now as a general rule of thumb, when you buy a stock or when you invest, be prepared to hold it for a minimum of 5 years. This way it will give you the time to see the compounding effect, and eventually you will see the power of the snowball effect. Fourth, accept that stock market volatility is normal. Now you hear a lot about irrational exuberance when financial heads opine about rising share prices, but irrationality also applies when stock market collapse. Now we can't control when the market rise or fall, but what we can do is to control our emotions. Now that means accepting that volatility is part and parcels of long-term investing. Now it's even better that it actually allows us to buy shares at a discount, and finding great deal is just like when you go shopping. Fifth, don't try to time the market. Now trying to time the market is a fool's errand. No one will be able to consistently sell at the top and buy at the bottom. Now the sooner you get used to the fact, the better it is for you to invest and be comfortable about staying investing. Now research has consistently shows that those who have stayed invested in a diversified portfolio will outperform those who try to profit from the turning points in the stock market. Now in fact, investing is about the time in the market and not timing the market.